Key Ladder's residential real estate investment education program. We're going to talk about investment financing, and this is part two of a four-part series on this topic. So let's get started with explaining what's in part two, and that would be down payment considerations, private mortgage insurance, paying down loans, refinancing options, and before you apply for a loan. With down payment considerations, you can purchase your first investment property. Generally speaking, this isn't the second or third one, but it could be, with as little as 10% down as a second home. You can qualify for a variety of programs doing that. Now, what we mean by a second home is you're supposed to live in it when you're not at your primary home. Now, that does not prevent you from renting this property on a short-term basis. This could be a vacation rental, for example, a little different than putting someone in there to lease it for, say, 12 months. But if you decide at some point after you purchased it that you want to lease it for 12 months, that's your choice. However, that's not the actual intent, but people do this. We're here just to tell you what's going on and not to recommend one way or the other. A primary residence for you to live in can be a multifamily property, a duplex, a triplex, or a fourplex. As long as you live in one of the units, you can obtain low down payment financing to do that. 10% to 15%, for example. Typically, you can also obtain a VA loan if you qualify for that with zero down using one of the multifamily properties as your primary residence. Now, there are people that use the VA loan to buy their primary residence, and then at some point down the road, they move. Happens a lot with military people who are reassigned, and then they decide to rent that primary residence. Now, with that VA loan still on that property, they won't be able to get another one, but generally speaking, once you get a start, you may not need one the second time or third time. You can get a 20% down payment for a residential single-family investment property. That is typical. 25% down is required for investor residential loans of 1 to 4 units. Seller financing could be anything. It could be zero down, it could be 10%, 5%, whatever the seller wants to do. The ones I've seen are typically something like a 10% down, and the seller will finance. There's a little closing cost if you go the official route and make sure that a third party handles the funding. Otherwise, it will save the buyer a considerable amount of money in the closing costs that are usually charged by the lender, and the buyer would then receive a quit claim for the property, while the seller then files a first mortgage on the property for the amount they agreed to. The sellers will generally charge a little higher interest rate because the buyers aren't always fully qualified. They may have a low score or not as much money down, and it still makes financial sense for the buyer to finance this way. It's also a faster way to get it done, and it's actually preferable in many cases. So consider that if it's possible. In fact, you should always ask if the seller is willing to finance, just as a normal rule. Now, there's zero down, 0 to X% down for wraparounds, and we'll get into wraparounds a little bit later with another section here that's an interesting type of mortgage, and I'll give you a couple of explanations. So let's cover private mortgage insurance now. It's no one likes to pay this. It's a dreaded cost. It raises your monthly payment, and it's required for any program where you're putting less than 20% down, and this is government or conventional loans too. And you can understand that with little down payment, there isn't much for you to do. You can simply walk away because these are generally all non-recourse loans. Now, what that means is that the property itself is the security for the loan and not you as an individual. If you decided one day you wanted to walk away, you literally can and have virtually no downside to that, except that it's going to be on your credit report for a long, long time. You may not be able to buy another property for several years. So PMI generally is on the loan for the life of the loan with a government-backed loan. That was changed a while back, so you can't get that off unless you refinance. And the other thing with PMI on your loan is it's up to you to do something about it. Even if you can remove it, you have to initiate the action to have the lender send out an appraiser at your cost and make sure that that property appraises at about 25%, so they have a little cushion in there. And that doesn't always work. Sometimes that backfires and it's not that much and you have to do the process over again. You're still going to have to pay that fee. So you have a choice. You can pay PMI up front. The cost is substantially lower than monthly payments. PMI is an insurance plan. It's just like the kind of insurance you buy for your house or for your car. That means that you can pay one time or you can pay over a period of time. And if you're paying over a period of time, then they're going to charge you interest, essentially, to do that. Very few people seem to know about paying PMI up front, so we're here to tell you that you should do that. Insist on it as a matter of fact. And then we'll talk about how much money you can save. So ask the seller to pay the PMI in closing costs. That's a popular thing that we always do for our clients. We have our participating real estate agents try to put that in there if it's possible to squeeze it in. Sometimes you're asking for so much in concessions that there isn't room for it, but if there is room for it, then put it in there and let the seller pay it. You can also buy right. If you buy a property with a reduced value, in other words, let's say the property is literally worth $100,000 and you're able to buy it for $75,000. When the appraiser comes out, there's 25% equity in it. You can avoid the PMI. That actually does happen when there are some savvy buyers involved or real estate agents. So I'll give you an example of a real estate agent that is one of our strategic partners. We work with him, and he and his partner were going to take a look at a property. It happened to be a multi-unit property, and he was able to convince the seller to give them about a 45% reduction in the in the value of the property. And they purchased it for that. They paid cash for it, turned right around and obtained a new mortgage on it and pulled cash out of it. So they ended up at the end of the day with 20% in the property, and they still pulled a lot of cash back out. So if you can accomplish that, you don't have to worry about paying off the PMI either. Here's a good example of how private mortgage insurance works with regard to paying it off. For example, the purchase price is $200,000 less a 10% down payment equals $180,000 to be financed. Real simple. The PMI on this is about $82.50 a month with about a 718 FICO score. And this is all an estimate here, so don't hold me to it. It could be $90, it could be $72, but this is close enough. Times 60 months is $4,950. The reason why I put 60 months in here is because we usually recommend a 5-year buy and hold on these properties, and that represents 5 years. So if you pay the PMI total at closing, the cost is $3,150. I had to avoid saying only because no one wants to pay any at all. So you save $1,800 over a period of 5 years, which is a 36% savings. Of course, if the seller pays $3,150, then you're way ahead of this. Now, if you happen to be one of those people that were asleep at the switch, so to speak, and never went out and refinanced your loan and just carried it for 30 years, you would pay $29,700. Probably there aren't many people that actually do that, but there are many people who will pay it for 10 years, 15 years without getting refinanced or asking the lender to drop it off. It's about as common as people who get an insurance policy on a house and never shop around, that didn't find out that insurance rates dropped 5 years ago, and they never shopped around. They keep paying the same rate plus an escalator. So this is a good example of having it paid right up front. So we're talking about paying down loans. I hear this from people, how they don't want to have any debt and they want to pay off all their loans. Well, let me bring up Apple as an example. Apple is one of the wealthiest corporations in the world, in the history of the world. They have tens of billions of dollars in actual cash type assets. And yet, with all that, they still have tremendous debt. Why would they have debt if they had all this cash to spend, right? Well, Apple borrows at a very low rate, a rate that's better than we can borrow at, and they lend at a rate that's probably as good, if not better, than we can earn. So imagine a potential spread of, let's say, 7 or 8% between what they pay and what they receive from their investments. They have probably a whole department in their company set up just to run all these investments, and it's a profit center on its own, and it makes money on, guess what, other people's money. So tell Apple to pay off all their debt. They'll laugh at you, as well as most other American corporations. Using other people's money is the road to wealth, but you have to get the psychology right on that. It's okay to have debt as long as you have assets to cover that debt. That's the whole point. Don't put yourself in a hole. Pay down loans if you will extract all the equity in, say, short term, 3 to 5 years. Okay, that's about the only exception that I say it. You know, if you're going to get the money back and you don't have a better place to put it right now, you can pay it down. It'll save you a few dollars in interest, not a whole lot anyway, the way these are already set up, plus the fact that there's so little equity earned in the first 5 years anyway. But that's the exception. Paying down loans negates the interest deduction, of course, and you can use excess funds for other investments that are earning, say, more than 4%, which is, you know, maybe the rate you're paying on your mortgage might be 4.5%, and you should be getting more than that for it. As a matter of fact, if you buy another residential rental property and you're making 8 to 9%, as our clients do, then there's a spread there automatically of between 4 and 5%, a good use of that excess cash. So you need to keep some excess funds in a liquid account of some type in case there's a problem. Oh, something like maybe a COVID virus problem, where you have more than 1 or 2 tenants, if you have a number of properties, that are having difficulty paying the rent. This would be a time when you had some liquid assets to help out. Now, not a lot, but we recommend between 3 and 6 months worth of rent and other costs in the bank or into something that you can grab. Just a few months ago, you could get a CD for 2.5 to 3%, short-term CDs, you know, for a year, for example, which is great because then you can keep rolling them over. It's a way just to keep that money liquid. Refinancing options. To reduce the interest rate and increase cash flow is a good reason to refinance a property, particularly in March of 2020 when rates are near historic lows. You can pull out cash to invest in other properties. Again, you're paying about the lowest interest rates you can pay in a mortgage. It's lower than borrowing money on a credit card or a line of credit, for example. You usually need about 25% loan to value to refinance. They say 20%, but you know what'll happen with the appraisal is it's going to be maybe a little funny. So just to give you a little cushion there when you're thinking about doing this, just think about 25%. Use a mortgage broker to refinance, which will give you a potentially better package, particularly if you have any issues with your credit. Not necessarily a negative issue with it. You may have a ratio problem where your debt to income is too high, for example. A mortgage broker may find a way to get that financed for you. So instead of going to a bank first and being turned down, go to a mortgage broker first and let them work their magic. Wait till sufficient equity and income for rents is higher. Well, that's a good thing to do, especially if you want to refinance, because part of being able to refinance is the income that your property generates. The higher the income, the more you're going to get out of the refinance. And if you're going to refinance, you might as well get all you can out of that property. Most lenders require a record of income from the property. You're going to have to show them that you earned this money. And let me mention one thing about that. There are property owners out there that let tenants do work in exchange for rent. Well, that's okay. There's a whole discussion on that, and you can check the Key Ladder website for a blog article about that, per se. But let me explain what that does for you on the negative side if you are exchanging that for rent. For example, let's say the rent was $1,000 a month, and this tenant was doing $500 a month rent work for you, and you were giving them a concession, and then they paid you $500. All you're recording is $500. That's all you're recording. If you want to get a loan based on the fact that you're earning $1,000, you're going to have to show that you put $1,000 in the bank, because lenders don't want to get into all this stuff about how John's doing some work for you and that type of thing. They want to see hard numbers. So what you can do is have John pay the rent for $1,000 and then write John a check for $500. It's a really good accounting practice. You're tracking how much money you're putting into a specific property, and there aren't any games here. You'll be able to sell your property at some point showing a higher gross income. Before you apply for a loan, this is in some cases well before you apply for the loan. Maybe you're planning 6 months in advance, for example. Don't finance anything big. This happens so often that I have to mention this. I thought it was pretty much a no-brainer, but for some people, they can't help themselves. I've seen people buy a new car or a new motorhome or something like that within a month of asking for a loan, and it becomes a real big problem on the ratio side for some people. It just throws them out. So don't do it. Wait till after you close if you're going to do something like that. Improve the property. The appraiser is going to report to the lender the value of that property, which will in part be the condition of that property. If you have deferred maintenance, you just didn't get around to it, or you decided to just pocket all the money and do nothing and allow the wood rot to show and the screens to fall off, the yard to go to pot, so to speak, you need to fix all of that, because it's going to have a bearing on your loan. You want to get a refinance on that property, or you want to sell it, actually. So improve the property before you apply for the loan so the appraiser sees it looking in really good condition. And it doesn't hurt if it's new paint. The appraisers like to see that kind of thing. Obtain comps on a regular basis from an area around you, say 3 miles, 4 miles. As you see properties that went up for sale that are somewhat similar to yours, make a note of it. You should already be working with a realtor in your area, and that realtor can get that comp for you, and you just write it down. Just keep it aside. This is the address. It sold for this much. And when it comes time for you to get a loan or to sell the property, you'll have all those comps. Let me give you an example where this works. One of our clients recently purchased a property. It was a house that's going to be converted to an office in a transitional area where it's approved. The lender went out and grabbed some comps for houses, not offices, because it really is a single family home. Well, they missed a comp for another conversion that was listed really as a commercial, and that comp would have pushed the value up another $10,000. So what Key Ladder did was we contacted the appraiser and said, here is a comp that didn't appear. Would you please reevaluate? The appraiser reevaluated, used the comp, which by the way was the highest of the comps, and that pushed the value up $10,000. So our client was better off as a result. So sometimes you have to help yourself. It'll also tell you what you might be able to get for the property when you go to sell it, so it's not a mystery. You don't just throw something out there and say, hey, this is what I want for the property, when your realtor tells you what it's actually worth. So you want full occupancy, and you want full occupancy at market rates. If you've been letting your cousin live there at lower than market rates, get that rent up before you apply for the loan. And if you have a vacancy, go out and get someone in there at market rates. So fill those vacancies first. If you cannot fill the vacancy before the appraiser comes by, be sure that you have comps in the area for the highest market rents, including maybe one or two units that you already have that are high market rents, and provide that information to the appraiser. You want to have contracts for all tenants available for the lender. This is essential. They're going to ask for them. Make sure the contracts are clean. They have start dates, they have end dates, they have lease amounts on them, and any other details that the lender would normally require from a lease agreement. You should be using a standard lease agreement that's provided either by a realtor, or you can get them online that have all of the different covenants in it and conditions, that type of thing. And make sure, because the lender it won't give you credit for the value unless there is a valid lease there. And if that lease is coming up due in a month or so, or a month or 2 months, then it's best for you to go out and just extend that lease and get another one re-signed, so that the lender knows that that money will be coming in after that loan is given. Pay down credit cards to less than 10% of the total credit unless it's a business card. Just to let you know, business cards such as American Express business card and other business cards do not report to credit agencies. So if you don't have one, you should probably get one and stop using your personal card. If you have personal credit cards, don't use more than 10% of the total credit available for at least 2 or 3 months before you apply for the loan. Make sure those are completely cleared off, and they can see that you have a lot of available credit. This will raise your score considerably. Check your credit. Fix anything that's wrong. You can get a free credit report once a year. You can also get credit reports from some credit card companies. Check it out. Look at every single item on there, all the creditors, everything that's closed in there, and make sure it's right. If it's not right, try to fix it. Contact the credit reporting agency and or contact the creditor, but do this well in advance. What you also don't want hanging out there is an inquiry that's unanswered. It'll show that way as a disputed item, and that bothers the lenders. Well, you've learned in part 2 of investment financing about a number of additional topics that will help round out your education on investment financing. So continue to part 3 and part 4, and be sure to take the quiz. Thank you for taking this segment of our course, and please continue.